Welcome everyone, this is the Tax Facts channel. We take tax information directly from the IRS publications and make videos. This video here is on the health savings account. Health savings accounts are tax advantage savings accounts used by eligible individuals to pay qualified medical expenses. Health savings accounts provide many benefits. Employees can make pre-tax contributions to their HSAs through their employer. When they do, these amounts are not subject to federal income tax, Social Security tax, or Medicare tax. If the employer contributes to the employee's HSA, the contributions are tax-free. However, the employer's contribution is taken into account for their total yearly contribution limit, thus limiting an individual's ability to contribute. There's after-tax contributions are tax deductible, the account funds can grow tax-free, and distributions are exempt from tax as long as they're used to pay for qualified medical expenses. Health savings accounts are very similar to medical flex spending accounts except for the risk of forfeiture. Unlike HSAs, the disadvantage of medical flex spending accounts is the use it or lose it aspect. What this means is you have until the end of the year to expense the entire fund or you lose the remaining balance. Now, some companies do allow a grace period at the end of the year to be able to use the rest of that account, and some may also allow you to roll over $500 or a specific amount. Not all of them allow you to do that, but some companies do have that option. If you haven't done so already, please like and subscribe and share this video with anyone you think might benefit from this. Now let's talk about the eligibility requirements. To qualify to contribute to an HSA, an individual must be in a high deductible health plan. They cannot be covered by other health insurance including Medicare. Now you can have accident, disability, dental, vision, and long-term care coverage. You cannot be claimed as a dependent on someone else's tax return. A high deductible health plan has a higher than normal annual deductible. It also has a maximum limit on the sum of the annual deductible and the out-of-pocket medical expenses that you must pay for covered expenses. Now, out-of-pocket expenses include co-payments and other amounts, but does not include premiums. Self-only high deductible health plan coverage is for only an eligible individual, and a family high deductible health plan coverage is for an eligible individual and at least one other individual. For example, you, an eligible individual, and your dependent child are covered under an employee plus one health plan offered by your employer. For the year 2022, the minimum annual deductible amounts are $1,400 for self-only coverage and $2,800 for family coverage. The maximum annual out-of-pocket limit will be $7,050 for self-only coverage and $14,100 for family coverage. Qualified medical expenses are those expenses that would generally qualify for the medical and dental expense deduction on Schedule A, Form 1040. Now, amounts paid after 2019 for over-the-counter medicine, whether or not it was prescribed, including menstrual care products, are considered medical care and are considered a covered expense. Expenses incurred before you establish your HSA are not qualified medical expenses. Now, HSA funds cannot be used to pay for insurance premiums other than long-term care insurance, health care continuation coverage, including COBRA, health care coverage while receiving unemployment compensation, and Medicare and other health care coverage for taxpayers age 65 and older. Let's discuss contributions. An HSA may receive contributions from an eligible individual including an employer or a family member. Contributions other than the employer contributions are deductible on the individual's return, whether or not the individual itemizes deductions. Employer contributions are not included in income. Now, there are some contribution limits. The maximum annual HSA contribution for 2022 is $3,650 for self-only coverage or $7,300 for family coverage. The employee's contribution limit must be reduced by any employer contributions made to the employee's HSA. There are no income limits or phase-out ranges with regard to HSA contributions. Now get this, there's an additional contribution. For taxpayers who have reached age 55 by the end of the year may make an additional catch-up contribution of up to $1,000. When you do contribute, you can make contributions to your HSA for 2022 up until April 15th of 2023. If you fail to be an eligible individual during 2022, you can still make contributions until April 15th of 2023 for the months that you were eligible. Your employer can make contributions to your HSA from January 1st of 2023 through April 15th of 2023 that are all allocated to 2022. Your employer must notify you and the trustee of your HSA that the contributions are for 2022. The contribution will be reported on your 2023 Form W-2 wage and tax statement. Distributions may be taken from an HSA at any time to pay for qualified medical expenses. Now, for non-qualified distributions, if HSA funds are used for any other purpose than to pay for qualified medical expenses, they are subject to tax and a 20% penalty. The penalty is waived if the account owner is age 65 or older, becomes disabled, or dies. Eligible taxpayers who are interested in saving more for retirement may consider using an HSA. Contributions are pre-tax and they grow tax-free. Distributions are used for eligible medical expenses, remain tax-free. Many banks that host HSAs allow account holders to invest some of their fund in mutual funds or other investments when the account balance reaches a threshold set by the trustee. This allows HSA funds to achieve investment performance that is similar to other retirement savings options. When the taxpayer reaches age 65, distributions that are not made for eligible medical expenses are subject to tax but not subject to penalty. Generally, a taxpayer will benefit from funding an HSA unless reducing their taxable income will decrease their refundable tax credits. Because remember, credits are more powerful than deductions. Deductions will reduce your taxable income, but credits reduce your tax liability dollar for dollar. Okay, this ends the video on health savings accounts. The information in this video is directly from the IRS publication 969. And thanks for watching. If you haven't liked and subscribed already, please do so. Hit that notification bell. Make sure you get all new videos that are coming out. You can find me on Instagram, Tax Facts in a Nutshell. I post short videos on tax credits, tax deductions, filing statuses, just a wide variety of tax topics. And leave a comment below if you have an HSA account and let me know how your experience has been. I'll be sure to respond back to you. It'd be great to hear you're taking full advantage of this great tax benefit. Okay, thanks again for watching, guys.